my dear international investors. Welcome to another program. In this video, I explain 4 important ratios every value investor should understand: the quick ratio, the current ratio, the price to book ratio, and the debt to equity ratio. Together, these tell you whether a business is financially strong, stable, and safe to own long term. The quick ratio tells you whether a company can pay its short term obligations without relying on inventory. It is a more conservative liquidity measure because it focuses only on the most reliable current assets like cash, receivables, and short term securities. For value investors, this ratio is important when evaluating businesses in industries where inventory loses value quickly. It helps identify companies that can survive downturns without needing emergency funding. A quick ratio above 1 usually means the company has clean liquidity and can manage short-term shocks. A quick ratio below 1 suggests the company might struggle if sales slow down or if inventory takes too long to convert into cash. The current ratio shows whether a company can cover all of its short-term liabilities using all of its short-term assets. It is a broader and more general measure of liquidity compared to the quick ratio. A healthy current ratio signals financial stability and the ability to withstand short-term disruptions. A very low ratio may indicate liquidity pressure or weak working capital management, but a very high ratio can mean the business is keeping too much idle cash or slow-moving inventory, which reduces returns. It is derived by dividing current assets by current liabilities. Value investors prefer companies that show balance, strong short-term protection, but not excessive capital sitting idle. The ideal business is liquid, efficient, and able to operate without constantly needing external financing. The price to book ratio compares the company's market price to its book value equal to net asset value, also known as shareholders' equity. It helps a value investor understand whether the stock is trading below, at, or above the value of the company's assets after liabilities. A PB below 1 may indicate a classic value opportunity, where the market price is lower than the company's book value, sometimes even below liquidation value. A PB between 1 and 2 is normal for healthy, steadily growing companies. A high PB means the market expects strong long-term returns on equity or values intangible assets such as brand, patents, or customer relationships. For intangible heavy companies, PB must be combined with ROE, ROIC, cash flow, and debt analysis. The debt to equity ratio shows how much of the company's capital structure is funded by debt compared to shareholders' equity. This ratio helps value investors understand financial risk, resilience, and the potential for permanent loss of capital. A low DE ratio indicates stability, lower risk, and more flexibility during economic downturns. A moderate DE ratio is normal for many well managed businesses. A high DE ratio increases financial risk because debt magnifies both gains and losses and can force a company into trouble if cash flows weaken. Most value investors prefer companies with reasonable debt or no debt at all. A business with strong cash flow and too much leverage becomes fragile, while a business with strong cash flow and low debt becomes a powerful compounder. In summary, the quick ratio and current ratio show liquidity strength. The price to book ratio reveals whether the stock is trading above or below its asset value. And the debt to equity ratio highlights financial risk and balance sheet safety. As value investors, we seek financial strength, durability, and low risk balance sheets. These ratios help you understand a company's true resilience far beyond just price and earnings. Thank you for watching. Please do subscribe and stay tuned. See you next time.